friends, this is Dr. Amarjeet Kaur, Professor of Accounting and Business Communication at the Department of Management, Gurugram University, Gurugram. So, this is my privilege that I am here with you to talk on sources of long-term finance. This is the topic which we started in the past. We have already covered two parts, and today we will be proceeding with part number 3 and part number 4, and it will follow part number 5 and part number 6 as well in future. So, sources of long term finance, we discussed about the major source, equity share capital in the past, and also introduced debentures. Today I am going to elaborate debentures and also going to discuss about their merits and demerits. Means we are going to learn the evaluation of debenture as a source of finance from company's perspective and from investors perspective both. So, friends, what are debentures? As we have introduced in the previous session to this in the past, that debentures are stocks, bonds, or anything which or any other security where the company has constituted some charge or without charge, against any security or without security. So, this is an instrument indicating that company has taken loan from somebody, right. So, depending on how many debentures a debenture holder holds, that much amount is the loan which company owes to the debenture holder, and otherwise debenture holder owns that much amount to be paid back to him, and he is entitled or she is entitled for the principal money to be paid back as well as the interest on that. So, it is a promissory note which is promising that we will pay. So, it is a financial instrument, of course, when it comes to debenture per se. So, it is a financial instrument, a piece of paper, of course, with the stamp of the company saying, promising that we will pay you this much principal and on maturity as well as the interest payable on the debentures as decided in advance. So, interest is also decided in advance for a normal debenture, regular debenture, and it is part of the debenture instrument. So, on the face of the instrument it is written 9% debentures, 10% debentures, 20% debentures, etc., etc. So, that percentage which is a prefix to the debenture series, that indicates how much interest is payable, right, to the debenture holder. So, this was what we introduced, we talked about. So, now the agenda today is that we want to discuss about debentures merits and demerits, evaluation of debentures. So, let us talk about merits or advantages of debentures from company's perspective as well as from investors perspective. So, from company's perspective, the first thing is it's a very low cost of capital. So, it has lower cost of capital. Number 2, it has no dilution or control possibility. Number 3, fixed rate of interest. And from investors' point of view, the advantage is certainty of income, certainty of repayment of the principal money, and priority of claim in the event of liquidation. So, let me explain these points to you. So, from company's perspective, the foremost advantage of having issued debenture is it has very low cost of capital. So, finance cost, which we all say, like finance cost for debenture is less. How come? If I am saying the 10% debenture, so you may assume the cost is 10%, right? 10% debenture means whatever the amount company has borrowed in the form of debentures, right? Let us say 1 lakh rupees, so 10% means 10,000 is payable. But the interest paid on debentures is considered for calculation of tax liability of the company. It is a tax deductible item. So, which means if a company, for example, I am just assuming is in 40% tax bracket, or in India we do not have 40% tax bracket, let us say it is 30% tax bracket. So, the actual cost to the company will not be 10%, will not be 10,000. If it is a profit earning company, if in that year the profits are earned, then the tax liability of 3,000, because we will get the benefit by 30%. So, my real cost of that 1 lakh debenture value will come down to 7,000 instead of 10,000. So, 10% is a very implicit, it seems, but the actual cost, that explicit rate on the debenture is 10%, but the implied cost would be after considering the tax benefits company would have, because the amount of finance cost, interest payment is subtracted very much in the statement of profit and loss account while calculating the tax liability. So, the real cost to the company is 7%. Though company pays at the rate of 10%, the investor will get at the rate of 10%, but because of the tax benefit, the cost to company will come to 7,000 in real, in actual. So, this is the first advantage of debentures from company's perspective. Second is that there is no possibility of delusion of control. What does it mean? If company issues, so this is a relative statement I am making in comparison to equity. So, if a company is issuing equity, and we know equity shares for the are marketable. So, that is a marketable security. In the secondary market on stock exchanges, equity shares are sold and purchased, right? And anybody intending or looking to have good control on a particular company, eyeing for having a larger control on a particular company, may continually or perpetually buying shares of that particular company. So, that ends up, or that results into the delusion in control. Control means the control on managerial actions, management, right? Because the participation in decision making is through votes, and then the number of votes are dependent on the number of shares somebody owns in a company. So, if somebody is consciously buying shares of that one company, the ownership is diluted, the ownership goes in the hand of that person or that company, and then the control is diluted. This is not the case in case of debentures, because debentures holder do not have power to vote, do not have power to exercise control in management. It is just a debt instrument giving right to get principal as well as the your interest money, paid back, of course with priority over even preference or equity. So, that is why this is an advantage to the company. Of course, every company cannot issue debentures. There are so many restrictions on issuing debentures. Company should be profit making company. Company need to have credit rating by a credit rating agency of A++ or A+. There are so many restrictions. So, it is not an option for every company. Even then, the companies which have the choice to issue debenture, they have benefit over the equity, because they do not have to worry about delusion of control. The third benefit is the obligation to pay interest is, on the one hand, is a disadvantage, but it is an advantage as well. How come? Company would know that this is exactly what I need to pay as a principal or as an interest, and company can start creating provisions, because this financial liability is known in advance, right. So, provisions for interest, provisions for or the sinking funds, provisions for repayment of the principal money can be opened up, and company, since is aware that I have to retire these debentures on this date after these many years, company is actually prepared. So, can because this is known. So actions are taken in advance, because company can preempt that company has a known liability, right. So, this known liability helps companies to prepare in advance, if the company has good intention of course, otherwise companies may not have the funds being created or ready to pay at the time of maturity. So these are the major advantages from the company's perspective, right? Now the advantages from the investor perspective is that they have very much certainty of getting the income in terms of interest, unlike equity share where there is no guarantee that a dividend will be paid or not. Company may be earning very high income, profits, but even after having a good amount of profits accumulated or earned this year, company may decide not to pay dividend. There is absolutely no right in the hand of equity shareholders to demand for uh, profits or the dividends, like profits to be distributed in the form of dividends. Whereas in case of debenture holders, they have legal right to demand for it in case it is delayed, it is not paid, right. So they are very much sure to get the income. That is how, it's a very fundamental rule in finance that higher the risk, more the return. So in equity, the return is higher generally because risk is also higher, and so is true in debenture. Less the risk and less the income relatively to than the equity shareholders or preference shareholders, right. So that funda of high, return and risk, adverse relationship between the two is always true and is in fact it is not inverse, it is a positive relationship, is always true in case of financial instruments, be it debentures or be it equity. So this particular investment gives a certain income to debenture holders. The second is, in case the maturity date is there, they know that they will get their principal money back on that particular day when it gets mature. So there is a certainty of getting or repayment of principal money by the company. Because debentures are, when issued, there are trustees. Somebody actually undertakes on behalf of the company to pay back the principal and as well as the interest. So trustees, indenture bonds are created, trust deeds are opened. That is how debentures are issued. So there are so many legalities which are fulfilled before issuing debentures. So that leads to getting a certainty of the repayment of principal money in case of debentures. That is an advantage to investors. The third advantage to investor is that there is a priority of claim in event of liquidation. The company, there is a possibility that company is not doing well, and the sinking fund which has been opened is actually going to help to pay back the principal money, or the trustees are there who have already ensured that the principal money would be paid back. But unfortunately or by choice, company is going to liquidate, is going to close its operation. The claim, the legal claim, if it is, if the funds are not ready, the legal claim over the assets to be sold and to be used to pay the principal money and the interest due to debenture holder, they have the first claim, right. So they have a priority on on the priority of claim on assets in case the company is going to liquidate. So this is the very important benefit that debenture holders have. So surety of interest, surety of principal money, and surety of being paid back in case of liquidation. So these were the merits or advantages from both company's perspective and from debenture holders perspective. Now I want to talk about limitations from company's perspective as well as from investors perspective. The first limitation from company's perspective is that it's a fixed burden of interest. Number 2, increased financial risk. Number 3, protective covenants are there. These are the 3 from company's perspective. From investors perspective, there is a interest income is fully taxable, no voting right and limited return. So let me explain these points to you. So the first limitation from company's perspective is that they have a fixed burden of interest. Either company has started, imagine if a business has just started, they are not earning profit in the during the gestation period. They are just either running in losses or are just breaking even. But nevertheless, company is required to pay the interest irrespective of it's making money or not. There are businesses in the initial years especially, or the businesses which are not doing well, they actually get loan to pay interest and the principal money, right? They refinance their loans, actually they need it to, in case they are not able to maintain funds, they are not able to, because they are not earning profit, they do not have surplus, they are not able to transfer to funds. So to pay, even to pay interest, they may have to borrow, right? So this becomes a very major limitation, because the financial burden is fixed and it has to be paid because of the legal right the debenture holders have. The second limitation is that the financial risk for any company goes high. Financial risk is the risk of not being able to generate enough money or cash to pay the interest, right? So that's deviation of expected returns, and not being able to pay the financial cost. So that goes high in case of debentures, because debentures increases the financial risk. And then there are many protective covenants which are issued by the trustees. The covenants in terms of that you cannot have the level of working capital below this level. You must maintain this much in debenture sinking fund. You must transfer this much in the indenture. There are so many covenants, positive and negative, to protect the interest of debenture holders. There is generally one member present as a director, or or otherwise in the board of the company. So this is required, that there is a representation of the trustee, the undertakers, the financial institutions, merchant bankers, whoever undertakes, be it an insurance company, or so whoever undertakes debentures issue, their presence is there in the management. So this becomes a kind of burden for a company, because somebody is sitting on your head all the time in your board meetings, giving you guidance, giving you guiding you not to do this or not to do that, or to do that or do this. So there are protective covenants which become limitations for companies. From investors' point of view, the interest which we get as debenture holders, that is fully taxable. So if I am getting 10%, 10,000 as an income or as an interest on my debentures, and if I am into 30% bracket, my real income comes to 7,000, right? So this is a taxable income. And the second limitation from the perspective of debenture holder is they do not have any right to participate in management. They do not have voting right, unlike equity shares, and in certain cases even the preference shares have certain rights. So no voting right. And then the returns are limited. The rate of return is certain, though in most of the cases, and is known in advance, but the returns are limited. So it's a safer way, is the safest investment into the corporate. But of course, if more the safe investment, the less is the safe secure. So as we know, returns are less in return, and risk goes hand in hand. High returns are in more risky investment, and less returns are in less risky investments, right? So that this is a less risky investment, but nevertheless it becomes limited return options for investors. So these were the limitations of debentures. Now I would like to talk about yet another source of long-term finance, which we call as term loan. So what is term loan? So term loan or project financing or project loan is a loan for a fixed sum of money that is repaid over a defined period or term with regular installments that include both principal and interest. These loans come with a fixed variable interest rate and structured repayment schedule. So you must have gathered, let me explain you what term loans are. From this slide you would have gathered that term loan is also known as project financing or project loan, right. This is the nomenclature which we use for this type of loan, and this is for a fixed amount of money, maybe 10 crore, 20 crore, 5 crore or 10 lakhs, whatever the amount is. It is to be repaid over a defined period. So, it means maturity is fixed, right. So, term. So, we call it term because term refers to the period. So, it is for a term loan for a term of 10 years, term loan for a term of 20 years, like that, right. So, it has a regular installment that includes both principal and interest, very much like debentures. Debentures may have the complete money to be paid during the year of their maturity, but term loans have generally even the principal money paid in certain installments, right. So, maybe starting point of the principal money could be after 5 years, the beginning first installment may begin in 5 years or in the first year after 1 year, but principal money as well as interest both are repaid on regular installments, whatever is been decided, because it is a negotiated instrument, it is a negotiated source of funds, and the loan they come with either the fixed rate of interest, right, 10%, 17%, 11%, whatever, or variable. In the variable could be this much fixed plus this much variable basis on the rate on treasury bills, etc., or fixed FDs, etc., right. So, it's because it is negotiated, any kind of terms and conditions could be decided. So, it is but it may have fixed or it may have variable rate of interest and a structured repayment schedule. A repayment schedule is always structured, that the repayment will start after 5 years, like it is very much like we get home loans. So, we know exactly how much we have to pay every month or after a year or so, or the business loans, you may start paying after these many years or maybe immediately after first year or first month, like that. So, it is a term loan which is structured repayment plan and with a fixed term and a maturity which is defined very well. So, this is what the term loan is. So, if I talk about the characteristics of the term loan, so what are the characteristics? Primarily, the term loan is a project oriented finance, it is negotiated, maturity could be 6 to 10 years, loan agreement is there and secured in nature, and it may have covenants positive and negative. So, let me just quickly explain these characteristics to you. So, generally term loans are offered or extended for a particular project, that is how we call them project loan or project financing. So, a particular project could be to set up a new unit in X city or Y city, to expand the plant from 10 TPH ton per hour to 20 TPH, like that. It is negotiated, it means there is a possibility to bargain the rate of interest, maturity or the repayment plan, everything. So, for the same amount of loan from the same financial institutions, two different companies seeking loan may end up paying a different rate of interest and different maturity terms, right. So, because it is negotiated. So, and maturities are generally from 6 to 10 years. Loan agreement is always done, is undertaken, is been signed by both the financial institution as well as the company seeking the loan, and they decide terms and conditions in advance. Most of the time terms loans are secured in nature, which means some kind of mortgage is being given, or it could be a building, it could be gold, it could be bank FDs, etc., etc. So, they are generally secured in nature, and there could be covenants which are positive or negative. Positive covenants are something that you must be doing, they become or they form part of loan agreement. Positive covenants say that one director from the financing institution must be present as a part of board of the governance, board of the management. right? Negative could be the company will never have taken loan after this loan from any other institution without seeking consent. So, the company cannot extend, or company cannot increase its liabilities. So, any kind of negative. So, negative means which restricts, positive means which requires some company to do something must, as a must. Now, coming to evaluation of the term loan merits and demerits. Merits and demerits for term loan are very much like debentures, which we just discussed few minutes ago, and restrictions through covenants. Another thing is through directors from financing institution is the core in term loan, because directors from the financing institution which are providing loans, they are present, they throw covenants, positive or negatives. This is the most important thing in term loan. So, I hope you were able to understand debenture, and understand the limitation and the advantages of having issued debentures, as well as the term loan and their features, their characteristics. So, these were the two important long term sources of finance we discussed in this half. So, I shall be concluding now. Time to sign off, friends. Thank you.